Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. Today is the 3rd of June, 2022. I'm here with Shaun Thiya from Prosperity, and we're going to chat to you a little about checklists and 2022 year, what businesses need to be doing. Shaun, thanks for joining us.
Thanks for having me on, Brendan.
No problem at all. Shaun, I guess it's this time of year we often look at checklists, what we need to do, whether it be businesses or individuals, and we'll do one for individuals later. But from a business point of view, what are some of the things I guess businesses should be thinking about every year, but also this year, 2022, as we approach 30 June?
Yeah, sure. It's such a great time to have a chat about these matters right now, and it just gives us a good 4 weeks to really have a think about it. I guess just to make sure some of our listeners are aware of some of the tax planning matters and just in general, what the world outside of tax looks like around June 30 as well. So it just seems like every year there are some new aspects that we need to start to look at, but also there are some matters that happen on a routine basis that we may or may not be aware of. So it'll be great to just have a chat through those.
Absolutely.
We'll take it just to dive in just around the businesses itself. So paying super early to get your deductions in on time. So where possible, we always advise our clients to get their super for their staff in early. The timing of these payments are crucial. So you only will actually get the tax deduction when the payment's actually received by the fund, not when the payment is sent, which does make it a bit tricky. So you can't really hope to make the payment on the 28th or the 29th or the 30th of June. Typically what they would advise is, for the sake of hygiene, that the payments are made well in advance of 30 June. So just to allow for the clearing time.
Yeah, absolutely. Just to jump in there, Shaun, I think that is a great point, because a lot of people are just trying to do it 30 June. And even if it hasn't cleared your bank account, even it's very difficult to get it in. And normally in the cycle, you're probably not even thinking about it till early July when it's meant to be due by the 28th. But if you want that deduction, it's a great tip. Get it in early, get it in, mid-June. Why not?
No, totally. And it's just to allow for the clearing time of funds. So most of the funds, they're using some electronic clearing houses that we may or may not have heard of. I think MYOB typically allow for a 5-day clearance time on these payments. So if you are looking to pay some of the super early for June, I'd suggest making that by the 24th to allow for that 5-day payment. It can be a bit hard actually working out the exact amount of super if your staff aren't on actual fixed wages, because you don't know what your monthly super bill looks like.
Yeah.
But in that instance, it'll be almost a best guesstimate to prepay what you think would be your super bill for that month as well. So
that's right. And I guess the benefit of that is you get the deduction in the current year as opposed to the next year. And that can be really useful if you've sort of had a good year and you want to bring it down, and next year, maybe isn't looking as good or something like that. So it can be beneficial to look at doing that. What are some other ones, Shaun? What else have we got out there?
Yeah, I guess staying on the topic of super, so 1 July, it also marks the increase of the superannuation guarantee rate, which is currently at 10%. So the rate is increasing now to 10.5% on the 1st of July. So just be mindful that I think what is set to happen by the end of this month is that the 1st of July falls on a Friday. So if you are doing your pay run for that week, 4 days of that week actually fall into the current financial year, and only 1 day falls into the new financial year.
Yeah.
So there's a bit of a trap there. If you're doing your pay run for that week, just make sure that week will have super rate of 10.5%, not 10%. So most of the modern accounting and payroll systems should automatically account for that, such as your MYOB, your QuickBooks, or your Xero. So they should automatically streamline the new rate of super in there, but it's always worthwhile just to check your pay slips before they're actually posted, just to make sure that increased rate is actually being picked up.
Yeah, that's right.
Before you approve it. But otherwise, on the super land, they are also abolishing the $450 minimum.
Yeah, that's a big one, I think. When you've got, and it's an important rule to look out for. And it doesn't affect everyone, but if you've got someone less than $450 a month, you don't have to pay them super. But that all changes 1 July. So even someone who's just getting a pretty small amount will then be required to have a super fund. So if you haven't set it up, or you've got someone who gets less than $450 a month, it probably is worthwhile getting onto that now to make sure they've got a fund. So
that's
you
it.
can start paying them in July.
Yeah, that's it. And probably also a good time to have a think about having a default fund for employees as well. So typically what you find is some of the younger workforce, they have not really thought about super. So they usually would sign up for a job. They would sign up for a job by just doing their TFN declaration. By the time they get to their super part, they haven't even thought about establishing a fund. So having that default employer fund set up just as a backup, just to make sure that one, you can still pay the super in time until the workers actually set their own funds up. I think that's a great option.
Yeah, that's right. It takes the responsibility away from you a bit. You've done the right thing. If you don't want to be caught out because they're not organised in their life. So absolutely. So super, always a good one. Love talking about super, and yeah, just a great place to think about planning. It's always the first step, I think, of super is a great spot. What else is out there, Shaun?
I guess one of the ones that will make some business owners want to spend a bit more money is the temporary full expensing, which I think there was otherwise due to finish at the end of this year, but they've now extended that till June 2023.
Yep.
Which is exciting for us, I think. So broadly speaking, Australian businesses, aggregated turnover of $5 billion. So should cover by and large most businesses that we service.
Absolutely. I don't have any turning over 5 billion. That's true, Shaun. I'm in that category. But yeah, that's right. So it's great for, if you're buying an asset that you're using in your business rather than depreciating it over 10%, 20%, or however many years it is, you can claim it all up front, which is fantastic. But I think there's obviously there's the carve out that first call everyone thinks of when you're talking about a large asset. What's the first call you get about, Shaun?
Yeah, no, it's all about what's the limit of the asset. So there is no limit on any asset, but there are specific limits on the type of asset. So cars, there are some special rules that apply for cars. So unfortunately, when you're expensing cars, they are still subject to the car limit. So that is currently just capped over $60,000 for the financial year.
Yeah.
So don't expect to buy yourself a fancy car that's over that amount, and also be able to get the tax benefit of that amount as well. But also one of the things that I get asked all the time is if it applies to utes. I know that, some utes these days are more than $100,000, and that would also typically fall under what most clients would think that, hey, this is not a car, this is actually a commercial car that I can use. Surely I can write the whole thing off. No, now the tax office have the view that you can still use your ute as essentially what a luxury car is. So the same limit applies to whether if it's a ute, van, truck, or just any other regular passenger car. So on the back of that, I think what also gets missed is just making sure that it's still the business portion of that car. So if you buy the car for $60,000, if you only use the car for, say, $40,000 for business use, that is still the limit in which you can claim. So it's not the entire car. If you've already got in your logbook, if you know what your business use percentage is, always worthwhile to just do a check before you put your tax claims in to say exactly what you're allowed to claim for that car.
Yeah, always good to check, absolutely. But you're right, when we talk about that temporary full expensing measure, the first call I always get is, what about cars? It's if you've got plant and equipment and it's a $150,000 printing press, well, yeah, that fully qualifies. If it's a big backhoe or something like that, that qualifies. But everyone always says, what about a car? So
yeah, that's it. Also, I guess I also get asked about whether if it applies to construction works or for secondhand assets. So for construction works, unfortunately, it does fall outside of what is an eligible asset. So that falls under another smaller part of the tax act, which unfortunately you can't actually write those off. They're a slow claim over whether if it's 2.5% or 4% for a longer period of time. And for second-hand assets, I think you're allowed to claim it if your aggregated turnover is below $50 million still. So some of the larger businesses won't be able to acquire the second-hand assets and be able to expense it immediately. But a lot of small businesses, even a lot of the medium businesses, would be in a position to buy the second-hand assets as well. So
yeah, great. Yeah, good points there. Good points. We'll keep it going because I guess we're a short podcast series. So what else? There's a couple of ones we've talked about: super, temporary full expensing. There's definitely 3 or 4 more good ones out
There
there.
are a few others. I guess more from if you are running a business, always have a look at your stock levels. So on the run up to 30 June, you've always got stock, and more on the lines of if there is any obsolete stock. So any obsolete stock, any slow moving stock or damaged stock, whether if it should be completely written off by June. If you can, great, you're going to get a tax deduction for that. So always a great opportunity to review your stock reports to see what hasn't moved in the year and what can't be sold. Let's get a write-off in before 30 June.
Yeah, at least you get the deduction then. That's right. So there's no point sitting there. If you can't sell it, don't pretend you can, and let's get on with it.
That's right. Also, I'd even extend that review to be part of your fixed asset register as well. So if there's any equipment that actually doesn't exist anymore in the office, it's also a good time to get it all written off, and just to make sure everything's a bit more tidy. You're going to get a tax deduction for it anyway.
Absolutely.
A bit better on hygiene side of things. On the topic of actually write-offs, you've also got bad debts as well. So any debts that you've been unable to collect from your customers, it is a dirty word. We don't ever want to hear about a bad debt, but unfortunately they do occur. But the saving grace is that there is a tax deduction when we do actually book it into our books, and then
don't write it off too early. But if you can't collect it, and you can't collect it, well, just don't pay tax on it. You're better off having it as a bad debt and not actually paying tax on it.
That's right. Yeah, that's right. One of the, I guess, probably one of the most common planning measures that we have here are around our Division 7A repayments for our party loans. And I guess, just for a bit of context, for some of the listeners who don't know what that means, it's probably the most common anti-avoidance measure that we deal with as advisors for our clients. And it's a bit of tax law that's designed to prevent private companies from making a tax-free distribution to their associates and shareholders. So I must start by saying that as an owner of a private company, it is completely normal and legal to borrow money from your own business. So it is a bit of a dirty word these days when you hear about a Division 7A loan, but it's there to help. It is there to help your business owners. But so with that said, there is a section of tax law that says if you do actually borrow money from your company, that you're still required to record that loan into a formal loan agreement. And if that does not happen, then you could fall into strife when it comes around to actually doing your taxes. So
yeah, and the full amount could be declared as a dividend all of a sudden, and you're paying tax on it in your own name. And
yeah. And it's just you don't feel it, right? Like you just actually drawn money, you don't see it as income, you think it's a loan, and all of a sudden you've got to declare it as income. So it's not the best discussion to have with clients, but we would like to get in front of clients as early as possible so that they're aware of what the implications are.
Yeah, and as long as you pay that back over the period, and you've got an interest involved, and there's set rates by the ATO on whether it be 7 years or 25 years if it's got security and things like that. So it's not a problem. It's just a matter of dealing with it and getting the paperwork in place and making sure you put the arrangements in.
Totally.
Yeah. Probably one of the other things I'll mention, Shaun, is that skills and training boost, technology boost that's out there. That was announced, what was that, probably a month and a half ago? And I think we had an election since then.
Yeah, I know. Well, that's the thing. It'll be interesting to see if that actually gets passed by law, to be quite honest. I mean, what is it? So you spend $100 on upskilling your staff and you can potentially get $120 tax deduction?
Yeah, you get the 100% of it this year, and then you get 20% next year, which, to be honest, sounds like a bit of a compliance nightmare to try and manage that, because you have to keep a register of all of those things. But the problem is they announce those things, and this one hasn't actually got through yet, and we've got a new government. I can't see them. They may, but unless they introduce it into Parliament, then it just disappears and we've lost it. So it's one of those sort of election pitches you have sometimes, that if the existing government doesn't get in, or even if they do get in sometimes, politicians don't always get everything they promise up and through. So it's one of those things that was talked about, but who knows if it'll actually go ahead. At this stage, I think it's probably doubtful.
No, true. And I think you find that most new parliaments have a way of stamping their signature on these things as well. So even if it is the same type of reform, they want to change it slightly to make sure that they own it, not the
that's right.
outgoing party. Yeah,
it'll be the slight change that makes it so great. So,
that's right.
yeah. Always the way. Look, a couple of great tips there. I think probably one last one I want to finish on before we wrap up is that I was thinking about is just 100A. So we've done a previous podcast on that actually, but just if you distribute from a trust to other people, and those people don't end up with the cash in their pocket at the end of the day, whether it be a bucket company, adult children, for example, just be mindful of those distributions, because there is some issues that are around. If they don't actually physically receive that cash, then it can be a bit of a problem, but that's a whole separate podcast on that. So jump back and listen to the old one. But thanks, Shaun Thiya from Prosperity Advisors, Associate Director down in Sydney. Thank you for joining us and sharing a bit of a few business tips there for year-end trial checklists, which is great. Shaun, if people want to get in contact with you, how can they do so?
Yeah, thanks, Brendan. So you can reach out by email. So email is probably the best way to contact me. My email address is sthiya, so sthiya@prosperity.com.au.
Great. And also jump on the website. You can track him down there. Or if you're after me, Brendan Campbell, so the same, bcampbell@prosperity.com.au. And thanks for listening in, and thanks for joining us today.
Thanks, Brendan.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.